week, we learned Target is planning to cut its inventory by rolling out markdowns and slowing buying. This after the retailer disclosed an inventory surplus of 43% coming into the second quarter. Here to discuss how retailers are grappling with the current inflationary environment is Infosys Consulting Partner Elizabeth Ebert. Elizabeth, thanks for being here. You work with consumer-facing companies on this whole logistics tangle that we are witnessing right now. Amongst your clients and amongst what you're seeing, what has changed most rapidly here that has seemed to have caught these retailers flat-footed?
I think the primary change has been around inflation and particularly gas prices. So just as one of your prior graphics showed, gas prices up 50 cents in the last month. That's on top of a lot of uncertainty retailers were having about forecasting inventory coming out of COVID and other general inflation concerns. So retailers depend very heavily on data and being able to sense and respond to trends with consumer buying. And there's just been layer after layer of hits that retailers have had a difficult time incorporating into their forecast models. So they've just needed to respond much more quickly because of the nature of buying merchandise, which oftentimes happens 6 months or more in advance. It's quite a bit like turning around an aircraft carrier and very difficult to respond that quickly.
Looking at some of these brands, many of them working with manufacturers to try and figure out what type of inventory they can even expect to get into their stores. And amid a wave of direct-to-consumer moves that we've seen from manufacturers across categories, do we see a reversing of that course if you have enough of those retailers or manufacturers, I should say, that are reliant on these retailers to actually move inventory through? And who's going to want to buy it even off of them when these retailers are still trying to move through the existing inventory that they have?
Yeah, the direct-to-consumer trend is really interesting, and we expect to see more manufacturers leveraging that, certainly through all the new ways in social media that allow customers to engage directly with manufacturers. The headwinds are certainly just going to come with the consumer sentiment and their ability to spend once they are dealing with their traditional and pocketbook issues around buying food and gas. So those headwinds will continue. So we see that as stabilizing more of a sort of an omni-commerce or omni-channel factor as consumers can engage with a brand and products in a lot of different ways. But right now, I think it's sort of a buck stops here issue with the consumer, and the direct-to-consumer initiatives are likely to face the similar headwinds that the retailers are as well.
Given where inventory levels are, Elizabeth, and given we are seeing an economic slowdown, do you think retailers are going to go back to their Great Recession playbook by offering really severe discounts?
Well, I think that we were in a very promotion limited environment. I know when we were talking about consumer sales around the holidays, consumers were complaining about the lack of promotions that were really helping with their holiday spending. And so we are seeing a return to more of a promotional acceleration, which is great news for the buyers and for consumers. However, that's where we're seeing the margin pressure for our retailers that is, the ultimate reflection of those promotions.
And Target sort of seems like the most extreme example of this, right? Having to come back again and retrench a little bit more. Are we going to see more of the retailers come out and make those types of dramatic changes to their inventory levels and to their forecasts?
Absolutely. Most of the big box or mass retailers are going to face similar pressures. Any retailer that has to buy well in advance. So they don't really have an option in many cases to cancel orders or to hold merchandise. We're seeing similar reporting coming out of Walmart, also with the Gap, for example, that's had particular challenges in their Old Navy brand. So I would say across the board, the trend is going to accelerate with retailers.
Look, they can't blame it all on Old Navy because Old Navy's done a ton for that brand for a while here. Infosys Consulting Partner Elizabeth Ebert joining us here today.
Arby's adding a burger to its menu for the first time in its nearly 60-year history. Now, the brand new Wagyu Steakhouse burger is now available, but if you want to get your hands on it, you've got to act fast because it's part of a limited time offering through the end of July. So here to talk about that, some of the trends that he's seeing in the fast food space, we have Jim Taylor. He's the president of Arbys, along with Yahoo Finance anchor Brian Sozzi. Jim, it's great to have you. Thanks so much for joining us today.
Thank you for having me. Appreciate it.
So, Jim, if I understand it correctly, you're joining us from Atlanta, from the kitchen where this Wagyu burger was created. Talk to us now that it's been available for a few weeks, and I should mention that we have some of these delicious burgers on set with us, but talk to us just about the demand that you've been seeing over the last couple of weeks.
Yeah, well, we have just been blown away. You know, America has said this is a product that we've been waiting for. You know, we love burgers. It's a quintessential American sandwich. And we've come out with one that is a premium blend of Wagyu that, look, I don't think you're going to find a beefier or juicier or more well put together sandwich than this one. And you're right. It started about 2.5 years ago in this test kitchen right behind me. And we've gone through over 20 formulations, ton of consumer testing to just nail it in. So it is, I think it's the best burger in fast food. Of course, I'm biased, but you guys can tell me that too, because you guys can sample it.
Hey, Jim, Brian here. Look, full disclosure, this thing's like a brick. I mean, this is a heavy
It's
burger.
heavy. Hey, use
how are you
two
making
hands.
money on this thing?
Don't be embarrassed if you need to, Brian.
No, I'm going to dig in for how do you make money on this? This is what, 52% Wagyu. You're charging almost $6 a pop. This is an inflationary environment.
Yep.
Like, is this a profitable item for you guys?
It is, you know, and I think it goes to show that, look, the burger business is ripe for disruption. I mean, we're happy with the food costs that we have on this, and it is a 6.4-ounce patty. It's over 50% bigger than other patties out there. And look, we just wanted to bring love back to the burger category. We thought that America would be interested in it, and lo and behold, look, we're blowing away our sales projections. Selling over 3 times the amount we thought. I wish we could have this in store through July. Unfortunately, you're going to have to get the Wagyu before it's Wag-on over the next week, probably.
Yeah, clearly you guys have the meat. So talk to me, Jim. How do you don't have grills in your restaurants, right? You guys make roast beef. How do you make the sandwich?
True. So, you know, we love this French cooking technique for proteins in particular called sous vide. What that is, if you haven't heard of it, is you vacuum seal the protein and you cook it low and slow in a water bath. What that does is it keeps all those flavors and juiciness together there, and make sure that you don't overcook it. So it comes in, you know, fully cooked, ready to eat to the restaurant. But what we know about a great burger is that it has to have a little bit of caramelization as well, right? So we flash fry it before we melt the cheese and prepare it fresh for every guest. And it's dynamite, you know? And I think it's not just the quality of that patty, but it's that sweet, tangy, smoky burger sauce, the lettuce, tomato, onion, creamy American cheese, buttery brioche. I love it, can't stop eating it.
Yeah, to say, I just took a bite myself, and it is very, very good. Jim, Brian brought up the pricing, $5.99, obviously a very attractive price here for burgers. Just talk to us just about leading a fast food giant in a time like this, trying to navigate higher prices, what you're going to be passing along to consumers. What has that been like, and what have you done?
Yeah, so, you know, one of the things that we've been really focused on is to stay at the forefront on culinary innovation. It's a calling card of this brand, you know. I think back when 2013, we launched a smokehouse brisket, smoked for over 13 hours right here. You know, the burger actually was our most successful LTO after this one in 13. And we also have on our menu this fantastic traditional Greek gyro, another premium great sandwich you can't get anywhere. And our philosophy is, look, if we provide these premium craveable sandwiches in a QSR environment, you're going to pay a lot less than if you go to a fast casual chain or an independent or a sit-down place. So we think that that is an opportunity for us to provide great value for premium products for guests that are looking to that and might give Arby's a shot. You know, we have over 25 sandwiches on our menu, and most of them aren't roast beef. Folks may not know that, you know, about 20% of our menu mix is new over the last couple years because we've been innovating, you know, during the time of COVID with things like our award-winning crinkle fries. We also got awarded the best chicken nugget in QSR, believe it or not. A whole breast nugget that we're super proud of, new market fresh sandwiches, And, of course, we have the smokehouse brisket, the traditional gyro, and also a killer Reuben on our menu each and every day. So, I'm excited for our sales results. We have grown over 150,000 average unit sales volume since COVID, and we're on track for our 12th consecutive year of same-store sales growth.
Jim, how recession-proof is a sandwich like this? If I'm doing the numbers, after tax, it comes out to close to $7.
Yeah, you're right. And I think that, look, in these type of times, food is something that is a simple pleasure that people can access every day that makes them feel just a little bit better about whatever they're dealing with. And so I think it is pretty recession-proof for the vast majority of guests.
Hey, my life is feeling great. I'm feeling great about myself right now. Have a couple bites of this burger, hanging out with Sean on set. Life can't get much better. All my troubles have gone away.
I'm telling you, hey, I'm going to join you if you don't mind.
Yep, dig right in.
Man, you got the gig, my man.
It's helping us detach ourselves from the sell-off that we're seeing here on Wall Street. But Jim Taylor, always great to speak with you, president of Arbys. Thanks so much for joining us.
Coca Cola is finally diving into the alcohol space. The beverage giant announced a new partnership with Brown-Forman to launch a ready-to-drink Jack and Coke cocktail. The product will debut in Mexico at the end of this year, followed by select markets globally next year. Joining us now in a Yahoo Finance exclusive is Brown-Forman CEO Lawson Whiting. Lawson, great to see you again. Look, this product makes all sorts of sense. I mean, this is a drink many folks have been drinking for decades. How much in sales could this do within the first 12 months?
Well, as you said, we're going to be launching in Mexico towards the end of this calendar year, and then a whole lot more markets, in 2023. We'll see. I mean, we haven't given any guidance on the absolute size of the product. It is a little bit difficult to know. There is a Jack and Cola product that's already quite sizable for us. It's a big business for us around the world. It's particularly big in places like Germany and Australia, but certainly putting the Coke label on the can is a game changer and something that we're really excited about.
Hey, Lawson, it's Julie here. Explain something to me. Why does putting this in a can, you guys obviously are not the only ones, right? We have seen this explosion in canned cocktails. Why does putting it in a can make such a difference than just pouring two different beverages in a glass?
Well, I mean, it's about portability and convenience are a huge issue there. I mean, we've been in this business for 30 years with Jack and Cola. So, I mean, it's already, as I said, a big business around the world for us. Consumers love it. I mean, if you take a place like Australia, just as an example, the RTD business is much bigger than what we call glass or the bottle Jack Daniel's business. So there is a consumer demand for these products. And when the pandemic hit, the business absolutely went, on a rocket ship and really took off as consumers were consuming at home as opposed to in the bars and restaurants. And so, there's a proven consumer demand for these RTD products. Obviously, there's a lot of people getting into the business right now, but they're not getting in with two of the biggest trademarks in their respective categories in the world. So, we're quite optimistic.
Beyond Mexico, how available would the product be to be able to be scaled up to other parts of the world?
Yeah, no, this is global. So this is a global agreement. And it's going to take us a little bit of time to get ourselves organized and get it into distribution. But I do think 2023 will be a big year. And this, for us, I mean, Coke has such a magnificent distribution system. Obviously, they're as large as they are. And so places like Africa, India, we see this really as an emerging market play, where places where we're not as big. And so, and it's exciting in those markets where consumers often can't afford an entire bottle of Jack Daniel's. They can afford a can of Jack and Coke. And so it's an entree into some of these markets for us, and another reason why we feel pretty good.
Lawson, I'm definitely wearing the dumb question hat today because I got very upset with Brian Sozzi yesterday for telling me that there would be a zero sugar version of this. I said, but surely there is sugar in whiskey. I was reading on your website, there isn't sugar in Jack Daniel's, which I have to admit I was shocked about because it tastes like there's sugar in it. So I know you probably don't get this question very often, but talk us through this process and what is actually in whiskey for a second?
Well, whiskey, the sugar goes out in the distillation process, but I mean, it's a series of grains and water. It's really not particularly complicated, more complicated than that. It's one of those things where every drop is distilled down in Lynchburg, Tennessee, and we export it out to the world. But it's obviously we've been making Jack Daniel's now for 60 or 70 years. And it is it's one of the best whiskeys in the world. And it is what we believe is the largest whiskey in the world. So, it's an excellent product that we're quite proud of.
Lawson, you've been at Brown-Forman for a good time. How do you envision your business performing if we do get a recession?
Yeah, look, I mean, the spirits business has been extremely resilient through a lot of different economic conditions over the years. And so good times and bad, we have performed fairly well, a lot more resilient than a lot of other industries. So we'll see. I mean, the one issue is does the consumer start to trade down? Brown-Forman in the last decade, 15 years or so, has really reshaped its portfolio to be more premium. So we shed most of our wine businesses. We still own Sonoma-Cutrer, but we sold the rest of them out. We've sold our less than premium spirit businesses for the most part. And so we are, our price points are quite high, which in one way means our consumer is a little bit towards the higher income scale. And so hopefully there won't be as much trading down there, but it's true there in past recessions and back in 2001 and in 2009, you did see some trading down. Now this Jack and Coke in a can could be a benefactor from some trading down because while it's still a very, very premium price point, it's not as expensive as somebody trying to buy an entire bottle, say, of Jack Daniel's.
And it should be noted too, not just Jack Daniel's, you're having a lot of success in the tequila business. But before I let you go, I want to talk about supply chain challenges. Now, where are you at in terms of glass shortages, can shortages, any of that ending yet?
Yeah, well, the glass shortages has been the story for us in the last 12 months. And when you really look at our business, it became a huge problem last summer. And we ended up knowing we had a finite amount of glass. We allocated it to Jack Daniel's Tennessee Whiskey. The on-premise was opening around the world. We wanted to make sure, as the biggest brand in around the world, that we wanted it to be available. And so that caused us to have big shortages for brands like Gentleman Jack and Single Barrel and Woodford and Old Forester and Herradura and the others. And so we are now in the process of reloading, and you would have seen that in Q4 for us. We were able to get a whole lot more glass and a lot more into the distributor warehouses, and it's just now getting into the consumer hands. And so, it bodes well for this fiscal year because we got a lot of inventory replenishment to do. The situation is not solved, but it is getting better, and we expect, and what we have told folks, that by the end of Q2 for us, we expect to be back in kind of a quote unquote more normal state.
Yesterday's decision by the Fed to raise rates by 75 basis points will have long-lasting impacts on the nation's economy, and our next guest even compares it to a car, saying before going into drive or into reverse, you have to put the car into neutral. Joining us now to break down the Fed is Rick Rieder, who is the BlackRock Global Fixed Income Chief Investment Officer. Okay, Rick, just break down the analogy for us and where the Fed is at in that process.
Sure. I mean, listen, the Fed, by the way, I thought the Fed did a great job yesterday. There's something really critical. I mean, last year, I think the Fed has been clear about this. Last year, too slow to move. You need to get to neutral. You can't react, particularly in a slowing economy. It's pretty rare in our careers to see the Fed tightening when the economy's slowing. But what the Fed has to do is they have to get to neutral. When you get to neutral, if you need to tighten more because inflation is higher, you could do that. Or if the economy's slowing too fast, we're going into a deep recession, then you can pivot and stop tightening or actually start easing. So getting to neutral, similar to the metaphor of driving a car, you got to get to neutral before you go in either direction. And I think the Fed is right. By the way, we're still at easy. You think about where monetary conditions are today, we're still at easy conditions. By the end of the year, we start to get to neutral. Fed's got to get there quicker. And I thought Jay Powell was incredibly good yesterday describing, listen, it may cost the economy some momentum, but we need to get there. And we certainly need to get off of easy conditions, and they're far from it. So I think moving aggressively and then saying, gosh, we may move 50 next time. And by the way, they could move more. But I think you need to show the world, and it's better for the economy longer term, and it's better for the markets longer term if you get there quicker, and then you can adjust and be flexible.
Hey, Rick, it's Julie here. It sounds like you have faith in the Fed.
Hey, Julie.
Despite perhaps them being late to try to catch up and get to neutral. And there have been a lot of questions sort of about the credibility of the Fed in the past week, especially with the sort of late, what looked like a leak on the 75 basis points. How were you feeling ahead of the meeting, and were you further reassured by the press conference?
So, Julie, I think the Fed, and I've maybe been too critical, I thought last year I didn't really understand why they were waiting so long. By the way, to go to the same silly metaphor, when you're driving a car, you don't want to put the emergency brake on, meaning you want to gradually do it. You want to tap on the brakes. And I think they were too slow in doing that. But now they're moving, and I think they're doing the right thing. You got to move, and you got to get to neutral. And as long as you communicate that we're going to get to neutral, but gosh, and there was a question yesterday in the press conference. Are you looking at the consumer data, consumer spending data? And the Fed's watching it. Are you watching the employment data? They're watching it. Listen, if the economy goes too deep into a recession, or we start increasing unemployment too high, then they're going to adjust. But listen, I think they waited too long, and we've been critical of that. But now I think they're getting ahead of the curve. By the way, the markets today, the Swiss National Bank was a pretty surprising aggressive hawk, and that's really impacted. It would be interesting to see what the markets, how they would have reacted if you didn't get that today.
And so, where are you in the recession camp here? Because Powell was very careful yesterday to say we are not trying to bring about a recession. Of course, I can't. It's hard to envision a world in which he would have said we're trying to bring about a recession. Right. But effectively, if he's also signaling that they're going to be aggressive here, that's the outcome.
So listen, if you ever had a situation where you could avoid a recession, today's the day. Inflation is extremely high. But you think about where the consumer is delevered. Businesses have termed out their debt, they've delevered. The debt in the system is actually sitting on the Fed's balance sheet, which is the most stable place for it to be. So you don't have a structural problem like you've had in the past. The consumer is in great shape. They're in a terrible mood because gas prices are up and food prices are up, and the net disposable income is changing significantly. But you can engineer a soft landing. You can do it because the system is in the place we're starting from. Business investment is extremely high. The place you're starting from is, you've got some room. And I think the chair talked about that yesterday. You've got some room. Are we going to see? I don't think we're going to see a recession this year. I think you're going to see one next year. But are you going to press? And by the way, I've heard different comments on this. Much of what's driving inflation higher is the supply side. We've taken 8 million barrels of oil off the market through Russia. The food price dynamic is largely because of the Ukrainian war as well. So it's a question of how much demand are you going to try and cut to bring down what is largely a supply issue. I don't know how people say it's a demand issue when you take. It's clear when you run the inflows and outflows that it's mostly supply. The question is, how much demand do you want to cut? How many jobs do you want to cut? You could cut millions of jobs, which we would argue is the wrong decision ultimately. I just think get to neutral and then see where we are.
Rick, we've asked you in the past about crypto markets. Are you surprised to see how crypto markets have reacted this week? And how do you think that landscape is going to react into what appears to be much more aggressive Fed tightening?
Yeah, it's a great question. When I think people underestimate, when you leave rates at such low levels for such an extensive period of time, we've seen this every time that the central bank keeps policy. When you go back to 2008, you can certainly go back to 15, 16. When you keep policy too easy, the leverage builds in the system / how do I capture return quickly? And you're seeing a lot of the leverage that was built up around crypto come unglued pretty darn quickly. So listen, I still think Bitcoin, crypto are durable assets. It's a durable business. But I think there was so much excess built around it in, gosh, this is my way to generate return when interest rates are so low, that I think you got to see that. And by the way, it's not terribly dissimilar from the internet bubble. When you go back to 99, 2000, was the internet a bad idea? No, it wasn't a bad idea. But you created so much excess around it, and you just have to de-gear that dynamic. And I think we're seeing that today. How far that goes. When things get a sense of momentum, people don't like losing money, and markets go down 5 times faster than they go up. And so it's why you're seeing this incredible unwind. So I still think it's durable. I still think it's going to go on, but I think there's a healthy recalibration going on. The question of how much that recalibration is going to go.
In that recalibration, what then gets set as a fair price for some of the crypto assets when you have kind of a flight towards a quality or something that's annexed to a viable blockchain?
So maybe because I've been doing it a long time, I can usually figure out free cash flow and figure out what an asset, what a piece of real estate is worth, what a piece of equity is worth, what a piece of debt is worth. It's pretty hard when there's no true intrinsic value. So what is it worth? It's worth what the next person will pay. My sense is in all these situations, you overshoot. And my guess is you probably got some downside to go from here. But it's hard to say what fair value is. My sense is if you look like a lot of assets today, if you look 2 to 3 years hence, they'll be higher than they are today. But, could you overshoot on the downside? This one's just hard to figure out, like gold, because I can't figure out my free cash flow multiple. I can't figure out what my security is underneath it. That's a tough question.
So, Rick, let's come way back into your wheelhouse then and talk about treasuries for just a second. Because are we going to see any abatement of the selling that we have seen in treasuries? We saw a little bit of it yesterday, actually. But in terms of the coordinated drop that we've seen in stocks and bonds this year, we had been getting commentary recently from some of the folks we've been talking to that that might reverse itself. What do you see happening?
I have to say, yesterday was one of the most incredible days I've seen in the markets. The buying that we saw in treasuries, by the way, I think it was a tremendous amount of short covering, but the buying we saw was incredible. It's like the Fed just eased. I didn't really understand what the market was doing. We moved the front of the curve, moved 25 basis points lower in yield yesterday. How does that happen? It was bizarre. It was almost as if the chair didn't go 75. Listen, I think the front of the curve's probably got some upward adjustment to do. I think rates can go a bit higher. We've said for a long time, when you get the 10-year to 3.5, 3.25, 3.5, I don't think we're going much further than that. So how do we get to that number? So let's say you think inflation, let's say 10-year inflation is the markets are pricing that at about 2.5%. 2.5%. 5 years is about 3%. So say, okay, what should the real rate be on top of that? I would argue if you get to 50 to 100 basis points positive. Now, again, we were running massively negative real rate. So let's say let's say long-term inflation is 2.5 to 3. You put 50 to 100 basis points of real rate, gets you in and around this 3.5 10-year. Can we overshoot a bit more than that? But listen, I think 90 to 95% of the rate move has happened, particularly out the curve, longer on the yield curve. Can the front end, if the Fed feels like, gosh, this inflation's stickier, nominal CPI is stickier because of food and energy, we got to go deeper. Could the front end back up another 50 basis points? Yeah, I could see that. But I think we're getting, like I said, I think most of that move has, out the yield curve has happened.
Always great to get some time with you, especially after the Fed meeting. Rick Rieder, BlackRock Global Fixed Income Chief Investment Officer. Always good to see you. We'll talk to you soon.
Let's stay on the theme of what the Federal Reserve did yesterday. The White House has made it clear that the Fed has a big hand in addressing inflation. So naturally, the question is, how does the administration view the big move from the Fed yesterday? Let's bring in Bharat Ramamurthy, Deputy Director of the National Economic Council, who joins us live. And Bharat, it's great to have you on the program. Obviously, the Fed making a pretty abrupt pivot before yesterday's announcement to that more aggressive interest rate hike. How are you kind of thinking about that? We know the Fed has the ability to lower aggregate demand. Thoughts on what you heard from Jay Powell yesterday?
I think what you heard from Chair Powell was similar to what President Biden has been saying, which is that we're in a transitionary phase right now in our economy. We've had a remarkably fast and equitable recovery from a recession under President Biden's leadership. And now we're in a transition phase where we're going to move towards steady and stable growth. And it's going to take a little bit of time to make that transition. But as I've been saying, the analogy I would use is that when we came into office and we were starting a marathon, we were a couple of miles behind some of our competitors, and we had to sprint to catch up. And we sprinted and we've caught up and we've actually taken the lead, but you can't sprint the whole marathon. You got to find a good steady pace that you can maintain over time. And that's the period that we're in now.
And the suggestion from the Fed chairman certainly that, it's not like we're going to see inflation go back down to 2% tomorrow as a result of that move. But broadly speaking, the conversation has kind of shifted from, okay, yeah, well, inflation could tilt us in a recession, but so could an aggressive path of rate hikes from the Fed. Is that something that you and the White House are worried about?
When you look at the economy as a whole, we're in very strong position. Consumer spending remains robust. Business investment remains robust. The unemployment rate, of course, is 3.6%. It's an extremely strong and resilient labor market, and not at all what you would necessarily have projected a little while ago. Remember, when we took office, the projection was that we would have 5% unemployment for years to come. It would take a long time to reach the point that we're at now. So we think that we are well positioned to handle what are, truthfully, a number of headwinds, most notably the Russia-Ukraine conflict, which is sending energy prices through the roof and affecting the prices of other commodities like wheat and other food products. So there are significant headwinds. I don't want to downplay that, but it is thanks to the president's economic recovery plan that we in the United States are better positioned to face those challenges, frankly, than many other countries.
Bharat, it's Akiko here. There are questions about to what extent the administration can move on anything in the face of this inflation, how much of that you can actually control. And we did see the president yesterday put out this letter addressing it to the major oil companies, calling for increased refinery capacity and output in the near term. I realize publicly this is what the president has said, but when you look at the broader market, I mean, if you're looking at a 5-year, 10-year timeline, the market is clearly moving away from fossil fuels. So how do you make the case for adding new capacity in the face of that?
Well, look, I think I want to provide a little bit of context on this. If you look at energy prices, which are obviously playing a massive role in the inflation that we're seeing, fully 50% of the headline inflation that we had last month was because of energy. And where we were at the beginning of this year, before Putin's aggression in Ukraine, we were looking at global price of oil of about $70 a barrel. That shot up since those actions up to $120 a barrel. That's a big part of the story. Another big part of the story is what's happening at the refiner level. When we had $120 a barrel oil before, prices at the pump were $4.25. Now they're about $5. And so that 75-cent delta comes down to the higher margins that we're seeing at the refinery level. As the president called for in his letter yesterday, he wants to put any creative ideas on the table that we can to expand refinery capacity in the short term. And as you said, there may be arguments for why in the long term we need to transition away from fossil fuels. But there are also maybe opportunities for us to expand refinery capacity in the short term in a way that makes sense for the industry and makes sense from the government's perspective. As the president said, he's open to using authorities that we in the government have to help ease that path if the companies can put on the table a set of policies, a set of ideas that are viable from our perspective.
When you look at the surge in energy prices, it certainly put the president's climate agenda, at least publicly, in a very tricky position. And I know the president tomorrow hosting a forum on energy and climate. And, I wonder how you tackle the messaging. I mean, on the one hand, you hear the president talking about increasing refinery capacity. You've got the president making the visit to Saudi Arabia to get more capacity output as well. And yet that's inevitably going to increase emissions as a result. I mean, how do you balance those two agendas?
Well, look, I think it's always been a slightly more complicated story than people have made it out to be. I think in the long term, the president has been entirely clear that we need to transition away from fossil fuels to clean energy. And I think the events of the last year or so have underscored that, have underscored why from a financial perspective, in addition, and a national security perspective and a climate perspective, it's important to move away from fossil fuels to clean energy. But it was never the idea that we were going to do that overnight. It's just not feasible to do it that way. And oil and other fossil fuels are going to be a part of our energy mix for some period of time, for some years to come. That was always part of the plan as well. So yes, we have to figure out how to manage that transition effectively. I think what we saw was a massive drawdown in refining capacity in 2020 when demand for oil and gas went down. But it's been very slow to recover. And I think if we look at it financially for those companies, it's been very potent. The big oil companies, the top five, have made $35 billion in profits in the first quarter of 2022. And they're sending a lot of that back to shareholders rather than reinvesting in production. What we are trying to do is figure out in the short term and the medium term, how do we bring more capacity, refining capacity back online so that we bring down some of those margins and provide relief to consumers at the pump. And at the same time, we do need to work on transitioning away from fossil fuels in the long term. And the president has put forward a climate package to Congress that he hopes that they act on.
So I guess then to drill down on that point again, is that a contradictory message to send, that you would want to turn on more refineries and do more production at the same time you're trying to lower the amount of environmental impact of all of this? How do the other world partners factor into this as well, given the interest in President Biden having a conversation with Saudi Arabia and other oil-producing nations?
Well, look, we've been clear that oil was going to be a part of our energy mix for some time to come. Already, we've seen more domestic oil production last year than we did in the first couple of years of the Trump administration. The projections are that we will have more domestic oil production next year than we've had in any other year in our history. And so we think that there is a business case for increasing refining capacity. And as we said, if there are things that the government can do to make that business case a little bit stronger, we are open to considering them, because this is a critical way of providing relief to consumers at the pump. And the number one priority that the president has is tackling inflation, providing relief to American consumers. And we think that this is a big lever that we have to do that.
Finally, Bharat, I'm noticing you're wearing a green tie. I can't let you go without asking about the NBA Finals. Brian and I have been watching your Twitter feed. The Celtics are on the ropes. They're gonna avoid are they gonna avoid elimination today?
Well, look, I'm glad that you noticed. I did wear my green tie as I'm trying to do my small part in cheering on the Celtics. I am confident about tonight's game. The Celtics have been a very resilient team, as resilient as our economy, for me to stay on message. And I'm hopeful that they're going to bounce back in Game 6, and then you never know what could happen in Game 7.
All right, well, we'll see. Hopefully no downturn for the Celtics. I would personally like to see Game 7. Bharat Ramamurthy, Deputy Director of the National Economic Council, thanks so much for stopping by this morning.
Childcare costs are also going up, and parents are feeling the pinch now. A new Care.com survey found that more than half of American families spend 20% or more of their income on childcare. For more on this, we want to bring in Tim Allen. He's the CEO of Care.com. And Tim, it's great to see you. First, I guess, just explain to us, give us a sense of how much people are spending on childcare per month and how that compares to what we were spending pre-pandemic.
Yeah, no problem. So what our survey found is over half of American families with children are spending more than 20% of their household income. The government actually recommends for that stat to be 7% of household income. So as you can imagine, we are far exceeding as a nation on multiple vectors what we should be spending on childcare. As you just flashed on the nanny rates, we've seen an exponential increase from when we did the survey in 2019 to the survey today in nanny rates, but also daycares and childcare centers. On average, you've seen anywhere from a 5 to 15% increase in the overall cost on both of those sectors, both nannies in home and also in childcare centers. In fact, if you have 2 children, it is actually the equivalent cost to be using a nanny as it is to be going to a childcare center. So that is a staggering fact that actually has taken shift over the pandemic. And what that's all as a result of is high demand. I don't know if you saw the news article there in Nashville, they were opening up a childcare center and they had families waiting overnight. They had 100 parents waiting overnight just to get a slot into that childcare center. So you have high demand with limited capacity. In fact, most childcare centers have a wait list of 2 years or more in some areas. So you are definitely seeing inflation play a role here, but you're also seeing a rise in demand with families going back to work and trying to figure out this new configurable schedule due to the pandemic.
And it really was difficult enough. I remember being 5 months pregnant and still being on a waiting list to get my daughter into a childcare. So I can't even imagine now how much more pressure that is. You mentioned the rapidly changing workplace, obviously with hybrid work. Is that making the picture for home care more complex?
It is. What we've actually seen is families are starting to what we call configurable care, set up configurable care. And that means multiple caregivers. That means caregivers that can come at certain sectors of time, meaning it's no longer a 9 to 5 economic issue for families. It is if I have an afternoon meeting or I know that my Tuesday morning is going to be full, how do I get care in those hours of which I need it to occur, especially if I'm working from home? with a hybrid environment, with a work from home environment for most white collar workers or a majority of white collar workers, you're seeing this flexible scheduling really come into effect where they're going, look, I don't need someone from 9 to 5. I don't need someone for just after school. I need someone for these in-between moments when I know that my schedule is going to get crushed. Now, then you have the other spectrum of the market, which is you have the essential workers, the workers who are going in every single day and don't have the luxury of sitting from home and working from home. So they still have to go to the warehouse or they have to go and work from the job or be in the office. You're seeing those members of society also go, wait, school ends at 3. My job doesn't end at 3. So how do I get someone to fill the after school hours or the after school schedule? So we've actually seen a real boost in demand on in-home care as an outcome of that.
Tim, taking a look at these rates that you have in the survey, $694 for a nanny per week, $226 for a daycare per week. When you take into account that people are paying so much more for their childcare, what kind of domino effect does this have on the economy?
Yeah, it's a great question. This definitely is share of wallet, right? It is eating up a share of wallet that doesn't leave for other goods. In fact, 31% of the respondents in the survey said that they were going to start looking for a second job just in order to afford both childcare and the things that they would like to go actually purchase or share inside of the economy. You have people who are reconsidering luxury goods or kind of non-essential goods such as travel, vacations. You have a lot of families that are starting to consider, and especially that we found out inside of the survey, how they're going to start to reduce their share of wallet in terms of being able to afford childcare. So it has this knock-on effect economically that really hurts us in terms of society from having more dollars to be able to be deployed into the economic factors of what, as the economy is continuing to try to rebound from a post-pandemic effort.
And to that point, obviously, during the pandemic, a lot of people, you were afraid to have somebody else in your home in case, in case infection spread. What about the nannies and the carers themselves? How are they faring in this sort of environment, and what sort of rates are they able to command?
Yeah, so it's been great for caregivers, and we've always advocated for caregivers to be above board, meaning like being paid above the table, really being able to be paid on a payroll, and we're seeing a lot more of that actually take hold, right? We're seeing a lot more families use our home pay system of payroll tax benefits where you can pay someone legally, because not only does the family get a tax benefit, but then the caregiver also gets a lot of the security in which they were lacking during the pandemic of things such as unemployment, or things such as, just some of the social security benefits of what occurs instead of paying someone legally. What is interesting is now with the demand so high, you're starting to see caregivers who are able to command a real reasonable livable wage, which is fantastic. We have babysitters who are commanding $30 per hour. And not only that, they're also being able to, the families are trying to entice them because there's such a limited amount of caregivers available at this moment in time with free meals, transportation. It really is a caregiver market at this moment in time in terms of being able to go out, gain employment, get either part-time babysitting jobs or get full-time nanny jobs. There's a real boon there. So you're seeing that supply and demand equation really fit in terms of the caregivers are able to go, hey, I'll do it for this. And it's really a caregiver market at this moment in time.
Certainly is. I'm seeing that firsthand as a mother of a 3-year-old and a 6-month-old. Tim Allen, thanks so much for joining us, CEO of Care.com.
There's a lot coming at the U.S. consumer right now. Gas prices over $5 a gallon, food prices through the roof, fears of a recession starting to take hold. Pull all this together, and we could be looking at a consumer spending pullback in the months ahead. Let's chat more about this with MasterCard's chief U.S. economist and friend of the show, Michelle Meyer. Michelle, happy Friday to you. Look, as I just said, there's a lot the consumer's dealing with right now. Are we at that point where consumer spending could just fall off a cliff?
Hey, Brian, thanks for having me on. Always good to chat with you. Yes, the headwinds are blowing very strong right now. There's high inflation. There's high inflation necessities, food and energy, as you noted, and shelter. At the same time, the Fed is trying to fight that by hiking interest rates. So there are headwinds. We do need to pay close attention to it. And their surveys are suggesting that consumers are noticing as well. That said, when you look at the actual data, when we look at MasterCard spending pulse data, the consumer is still out there spending. We actually saw an acceleration in the year-over-year growth rate in May relative to the prior month as consumers get ready for the back-to-school season. So there are challenges. We should expect a moderation looking ahead, but by no means are we seeing anything that resembles a collapse in spending here.
Michelle, you've been doing this for a while. Are you surprised we haven't seen a sharper pullback?
I'm not, for a few reasons. The first is look at the labor market. right? We still have very high job openings rates. We still have very strong job growth. The last jobs report showed 390,000 jobs were added across industries. The unemployment is very low. Wages are rising. So there's support in terms of that fundamentals in that people have jobs. They expect to continue to have jobs. The other very, very important factor is that they have savings, right? This last year was one of extraordinary stimulus, monetary stimulus, fiscal stimulus, and that created a lot of cash on balance sheet. And those cash levels are still high. So people have the ability to use that to help to finance spending. So what we're seeing in kind of the simplest form is a reversal of that real excessive stimulus, right? We're seeing that pullback. We're seeing an attempt to rebalance the economy. And that does mean a moderation is going to come, but it doesn't mean that it has to be this abrupt change in the course of the economy.
Michelle, do you believe that supply chain issues will be, and these have made inventory levels extremely unpredictable for some retailers, do you believe that they'll hold up to a necessary standard or at least a level that will make it stable enough to meet some of the spending pulse goals and targets, at least in forecasts of 7.5% growth during the back to school season?
Yeah. So the supply side is critical. And I'm glad you brought that up because it's not just when you think about the economy, it's not just how much consumers want to buy, it's how much is available there. And this has been a major challenge in the past year to 2 years is that supply chains were limited. They were broken for many items and inventory levels fell to very low ratios. And as a result, prices increased dramatically. The good news is that that's starting to be resolved for certain products. And in fact, you do hear some retailers that have had, just in case inventories actually sitting on some decent stockpiles now. And in the end, that can maybe even lead to some disinflation, which would be really quite welcome given the inflationary pressures that are out there. So I think that there is product available now more so than certainly a year ago at this time. Remember also that consumers have shifted their prioritization around spending. You're seeing a lot more experience-based spending, travel, restaurants, lodging, and you're seeing the items that go along with that. So kind of occasion apparel, for example, where people want to buy certain items in order to experience life again and get back out there. So there's differences in the consumer wallet. The story's going to look very different depending on what sector you're focused on.
Michelle, just a follow-up to that, because as we're thinking about how the retailers themselves are kind of navigating this environment, the operating costs for the sales that retailers are banking on, they're vastly different than they were this time last year in terms of the 2019 comps. And so all of that considered, from your perspective, is there an outsized risk of some margin compression on their front if they have to discount at the same time that they are going into the back to school season, even in the holiday season?
So I think the challenge for retailers right now is to be as nimble as possible in terms of responding to consumer demand. Everybody was caught off guard right when the pandemic hit and people wanted to snatch up as many goods as they could, big ticket items, everything related to housing. And there was a major shortage and we couldn't accommodate that demand. And now that has changed, right? Where there's a lot more spending related to leisure and again, this kind of experience economy. So it's about being nimble. It's about being able to respond to these changes in consumer behavior and being able to realize where, and how you can pass on costs. So, the consumer is the pulse of the U.S. economy, and trying to understand what's happening in real time, I think, is critical.
Michelle, do you think we are talking ourselves into a recession? I realistically, this weekend, President Biden's comments to the AP in his latest interview about a recession and things slowing down, that's going to be played all over the place over the next few days. Yeah. And if you see those headlines, maybe you're just less inclined to not go out there and buy a new shirt.
Yeah, so I like the Google search chart you pulled up. I look at that myself because I think it is important to understand kind of the buzz, right? What's the animal spirits out there? How concerned are people? Because when they hear about recession, they start to wonder. But at the same time, they're also looking at healthy income. They're looking at money out there. And they're still trying to, resolve some of this pent-up demand that they've had for a long time. So, animal spirits matter. Behavioral economics is really important. So we do have to think about these sentiment changes and how people are perceiving the economic environment. But also what they're getting in, right? Income in means a certain amount of spending out. So to me, the recession story, I think it's smart to be thinking about these headwinds. I think it's smart to be thinking about the path of the economy looking forward. And a lot of these recession calls are about 12 to 18 months forward. I think it's hard to say a recession is around the corner. We're just not at all seeing that in the data. But to say that there could be some considerable risks into the future, absolutely. We should be thinking about that. You have a real pivot in the economy with the Fed hiking interest rates dramatically and trying to cool down the economy to rein in inflation. But we have to be careful with how we characterize these recession risks, in my view.
Michelle, always great to get your insights and perspective. MasterCard's Chief U.S. Economist, Michelle Meyer, thanks so much.